is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Rome for the elections, and here's what's coming up on today's program.
To come, we've only been here 19 days. I want to see over the next year people retain more of their income, because I believe that it's the British people that are going to drive this economy, and that's why I want people to retain more of the income that they earn.
Sterling crash, the pound plunges to a record low as Chancellor Kwasi Kwarteng vows to press on with tax cuts. Watching for intervention, expectations mount for assertive action from the BOE, with Deutsche Bank calling for an emergency jumbo hike. Plus, the end of the Draghi era, while Italy's Giorgia Meloni wins a clear majority in Sunday's election, ushering in the nation's most right-wing government since World War II. So, the market's really falling out of bed, especially when you look at the UK. So let's first of all check the markets overall, but extreme pressure on currencies all across the world. The pound plunging to a record low. UK gilts crashed to actually send the 10-year yield above 4% for the first time since 2010. In fact, there's a huge repricing of the whole UK gilt curve. Let's bring in Bloomberg's MLive Mark Cudmore. Mark, I don't know whether once we get a dollar to the pound, that's a floor, or whether it goes even lower.
I think the pound will definitely go lower than here unless the Bank of England validates the yield pricing we've seen today. So at the front end of the curve, we've seen pretty extraordinary move in yields. The two-year yields are up about 50 basis points, a little bit lower just as I walked into the studio, but earlier on today it was a little bit over 50 basis points. And unless the Bank of England come in soon and say, look, this market pricing makes sense. Now, they might get away with only delivering that via rhetoric by saying we're going to hike very aggressively in November. But much more likely, they're going to need to actually validate with action. They might be forced to an emergency hike. If they don't, the currency remains the only outlet for the UK's twin deficits, where traders continue to be concerned.
So, Mark, I don't know whether there's a huge repricing in terms of gilts and whether that continues going forward, or whether we're just going to see more on the currency side.
So I think that we're going to get more pressure both in gilts and in the currency. Ultimately, we still have deeply negative real yields at this level. And you know, that's very difficult when you've got a country that does have twin deficits. So when you've got twin deficits in a world of rising yields, well, how do you make your debt more attractive? Because you've got to fund those twin deficits, and that means a debt problem. So either you can offer much more attractive yields, and at the moment with UK's inflation rate, they need to hike rates hundreds and hundreds of basis points to get close to positive real yields. So the debt is unlikely to be attractive. So the only other way you can fund those twin deficits is by offering a massive discount through the currency. And that's why the currency has weakened so much this year. And that's why the pressure is going to remain on until people feel enough of a discount is either priced through the currency, or we get some significant rate hikes to ease up on those negative real yields, or most likely some combination of the two.
Mark, I'm kind of transfixed. I have to say, I'm looking at the market moves and I'm thinking, like, what did the Chancellor say? Why did he double down? I mean, they're really betting that this will spur growth down the line. If you're the BOE, how do you react? So you can't be seen as just going, you know, against your Chancellor straight away. But if they move by 150 basis points, like markets are pricing in, what does that do to the economy? And what does that do to pound?
So the economy is in trouble, but actually the Bank of England have been given cover to move. Because remember, it's only last Thursday that they hiked 50 basis points when the market was kind of saying, look, 75 basis points might make more sense. So they were on the slightly dovish side. Yes, it was a hawkish 50 basis points hike, but they were dovish side of expectations on Thursday. Now, suddenly, if they're going to deliver an emergency hike or justify much more aggressive hiking, well, they can say, well, it's the government's mini budget that provides this cover. It's the government that's providing fiscal stimulus that lets us tighten on the monetary policy side. And that might make sense if they're given time. You're talking, Fran, about whether they can get away with 150 basis points in November. They're going to have to deliver much more than that, and probably earlier. I do think the chances of an emergency hike at some point are rising, unless we really get some very, very aggressive rhetoric from the Bank of England, or we get the government slightly rolling back in their idea that they're going to continue with unfunded tax cuts. But at the moment, it's an unsustainable situation. So either we get an emergency hike or we see much lower prices in the sterling.
So, Mark, and I know, I mean, this is a nightmare, right, for the balance of payment, for the twin deficits, and actually the UK also doesn't export much, so it doesn't really help at the margin at all.
No, I mean, look, you're right that the economy is in trouble. So if they hike rates, yes, the more real yield they offer is slightly better. Now, today, we've finally seen 2-year UK yields rise above US 2-year yields. We've seen 10-year yields in the UK rise above 10-year yields. We've got the whole curve above. So suddenly, UK debt is starting to look more attractive on a relative basis, at least in nominal returns. But of course, we have real returns, and UK's inflation problem is worse. You are right that the Bank of England does tighten rates aggressively. What's going to happen to the economy? The UK economy is in deep trouble. No matter what happens, we've been gone beyond the case of worrying about the UK economy and marginal issues there. We know the UK is going to have a terrible 2023. We know it's going to be in deep recession. What we're worried about now is stopping a currency crisis. We can't be concerned about the recession in the UK. We've gone way beyond that level of concern.
All right, Mark, thank you so much, as always, for your great insight. Mark Cunmore there from our MLive team. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. A number of small protests have broken out in Russia against President Putin's conscription plans. This as fears grow that the Kremlin may ban some men from leaving the country. Over the weekend, people waited for hours in long lines at crossings into Finland, Kazakhstan and Georgia. Moscow attempted to reassure citizens, saying some will be exempt from being forced to join the army. Now, China's Communist Party has reaffirmed President Xi Jinping as its core as it published the list of delegates for next month's landmark twice-a-decade leadership summit. Xinhua news agency says more than 2,200 officials were elected for the 20th Party Congress. The twice-a-decade gathering starts in mid-October, with President Xi Jinping expected to secure a third term in office. The Philippines is holding talks to buy fuel and other commodities from Russia. President Ferdinand Marcos Jr. told Bloomberg the country is close to deals with some fuel suppliers. He said the Philippines' national interest in diversifying energy sources overrides concerns about Russia's invasion of Ukraine.
Now maybe we need to approach Russia and say that maybe they can loosen up and provide us with some fuel. The political side of it has been, of course, a little tricky. But nonetheless, the national interest comes first. And so we have to find those new sources of fuel.
Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Coming up, Giorgia Meloni wins a clear victory in Italy's elections, setting up the country's most right-wing government since World War II. We discuss economic policies next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Rome. Now, Giorgia Meloni has won a clear majority in Sunday's Italian elections, setting herself up to become the country's first female prime minister at the head of the most right-wing government since World War II. Now, we're joined by Marco Elzer. He is partner at Lonsin Capital. Marco, thank you for joining us.
Good morning,
every time I come to Rome, I usually try and catch up to ask about the markets, but actually the markets are pretty okay about Italy right now. They're freaking about the UK.
Is the UK. The biggest problem
is the UK. Is the UK a warning shot for Italy? You can't spend too much, keep your deficit in check, keep your debt in check, or else.
It's definitely a huge shot across the bow. The fact the Italian markets have not reacted, the world market have not reacted to Meloni's victory is actually a good sign. But I think what's happening in England really is very, very scary. And Meloni is going to have a very difficult challenge to get everything organized, because some of her partners are believing in spending cuts, tax cuts, excuse me, and that is not going to be good for the economy. And the same thing the UK is doing. So do you think
Marco she'll go ahead with tax cuts given what's happening in the UK and pound at a record low?
She's a very smart person. She's from Rome. She grew up in Rome, and she is very, very ambitious. First of all, kudos to her for having won the election. The first time a woman becomes president of the Consiglio, prime minister in Italy. I think she's going to be smart enough to realize that certain of the promises she made, she will not be able to maintain. And she'll be frank about it.
Yeah, so do you think actually she'll be Euro-friendly? She has been in the past Eurosceptic, and I think part of the largely muted market reaction is they're really trying to figure out what she'll do.
Reading into her, I've never met her personally, but I think her political views are pretty straightforward. She's very much pro-Ukraine, pro-Europe. The problem is...
She hasn't always been pro-Europe.
No, she hasn't been.
Right.
Well, tomatoes ripen, they're green, they become red, they ripen. She's changed her views, she's matured. The problem is, I think, is her political allies who may have different views. And that's going to be the biggest challenge for Georgia, to see how she can coalesce sometimes warring factions within her own group.
Right. But she has a big majority. She's done better than both the other parties put together. So she doesn't have to listen to them or be warring with Europe or warring with Germany.
When you see, well, first of all, with regards to Italian politics, I think the fact that Lega, which was Italy's very, very successful party, literally imploded since the last elections, and there's going to be some very strong requests to change the leadership. Hopefully Salvini will leave and will be replaced somebody much more intelligent, much more market-friendly, like Giorgetti, who's a very, very erudite, smart person. That could help, and that would actually help Meloni create a plan which is financially viable, because Meloni's biggest, I shouldn't say a flaw, but her biggest lack is she does not have the political experience.
Right. So who does she put as finance minister? This is, crucial for for the markets to remain comfortable.
I mentioned Giorgetti. I think he's a very, very smart person. I don't have the same views he has, but he's very, very smart, and he is very much listened to by the European Union and by international markets, because he's proven what he's done has been very, very coherent with democracy.
But how she'll deal with the cost of living crisis? I mean, this is a huge problem, right? Energy prices, because of the link also between Italy and Russia, will skyrocket like the rest of Europe, but maybe even more. And this country has a huge debt problem. Will they have access to the 1.9 billion that the EU will give them in December?
With regards to the funding from the European Union, I'm not concerned about, because Draghi's philosophy, whatever it takes, is still the ace of spades, and that's going to work. That's the reason why I think Italian markets have not reacted, Francine, after yesterday's results. I think the problem really is going to be what Conte and his really, really not very smart idea of just giving away money. The reason why M5S, Five-Star Movement, which has got a significant amount of votes, they didn't earn the votes, they just bought them. They promised people money, and people voted for them, which is really, really not very good. And I think the first thing Meloni should do is literally eliminate that. That's going to show the financial markets that she is thinking straight, because a lot of these people, you have to know, and the viewers...
Marco, the other concern, of course, is some of her stance in the past on LGBTQ communities, on the fact that she's praised also Viktor Orban, on her talk on immigration. How will she govern? We're talking about, is she far right? Is she not far right? You speak to people around her, and she says, look, this is a candidate that's matured, that's changed, and that will be more mainstream.
Look, at the cost of making an analogy, which may not be the best analogy, Luigi Di Maio, who was actually a pretty good foreign minister, Minister of Foreign Affairs in Italy, used to sell soft drinks at the stadium. So people do mature, they grow, they change their views. I think Giorgia Meloni, notwithstanding her past, that she was very close to extreme right, I think has matured, and she's going to realize that if she wants to be a leader and be remembered as a leader, she'll have to come.
But I keep on being told that actually politicians don't always mean their words, and what they say is full of political votes. But actually what Trump has taught us, what also Boris Johnson has taught us, Liz Truss, is that usually when you promise things, you try and follow through once you get elected.
And Liz Truss is the proof that poor cable has just collapsed to all-time lows this morning. I think, look, I don't know Giorgia Meloni. She's honest. She does not have a reputation of being a corrupt person, and she's going to do the good for Italy. She's not going to do the good. She's going to do what I think Obama did be the president's for all the people. Her views on LGBTQ, her views on immigrants, I think are going to have to be perhaps filed down a bit.
Yeah.
That's my only hope, because otherwise Italy's going to be a pariah. Now, what you properly said, Francine, is that what happened to England today is a wonderfully timed warning shot for Meloni to watch out.
Yeah, I wonder whether Meloni's looking at pound like we do. Maybe. Marco, thanks so much. As always, Marco Elzer, partner at Lonsin Capital, joining us on a rainy rooftop in Rome. Now, coming up, sterling crash. The pound plunges to a record low as the Chancellor, Kwasi Kwarteng, vows to press on with tax cuts. We'll have plenty more of that next. And this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance, early edition. I'm Francine Lacqua here in Rome. Now, Liz Truss's new government has a dramatic start with the pound plunging on its tax plans. Let's go straight to Lizzie Burden, who joins us from the Labour Party conference in Liverpool with a guest. Hi, Lizzie.
Hi, Francine. Well, I am in Liverpool at Labour Party conference with the Shadow Chancellor, Rachel Reeves. Rachel, thank you so much for joining me. Over the weekend, the pound has tanked because of the news that Kwasi Kwarteng is going to add to his fiscal package on Friday with even more tax cuts. Now, you have called it casino economics, but what if Kwasi Kwarteng's gamble pays off and we all feel pretty good by 2024?
Well, we saw on Friday the markets begin to react to what the Chancellor set out in his statement, a series of unfunded tax cuts, primarily for the richest in society. And that has put pressure on sterling, not just against the dollar, but also against the euro. And that has consequences in the real world, because it will push up inflation further. It pushes up the costs of government borrowing, and in turn, it will mean higher borrowing costs for families and for businesses as well. So at the moment, we've got a situation where the Bank of England is got its foot on the brake, and the Chancellor's got his foot on the accelerator.
So should the Bank of England be intervening
that is road to ruin.
To save the pound? Should Andrew Bailey step in?
Well, look, I was an economist at Bank of England for many years before I became Member of Parliament, and I respect the operational independence of the bank. But the bank has a clear mandate to control inflation, and they will see the impact that is happening now on sterling and the impact that that will have in turn on inflation. And so there will be further pressure on the bank to increase interest rates. And as I say, that means higher borrowing costs for families and higher borrowing costs for businesses, which is why I fear that for all the talk from the Chancellor last Friday, this is not a plan for growth, because if families have got less money to spend because they're spending more on mortgage interest payments, and if businesses are put off investment because of the cost of borrowing going up, we're not going to get the growth. Trickle-down economics is not going to work. It hasn't worked in the past, and this is just putting further pressure on inflation and interest rates.
So should Kwasi Kwarteng step in to save the pound?
Well, Kwasi Kwarteng at the weekend fuelled this sell-off of the pound by doubling down on his package on Friday and suggesting that there is more to come. That is not what financial markets want to hear. They want to hear that the Chancellor has got a serious plan for getting a grip of the public finances. We didn't hear that on Friday. We didn't hear it over the weekend. And now we have that reaction in global financial markets to the irresponsible and reckless statement that we had from the Chancellor on Friday and the comments through the course of the weekend.
So what financial markets and business want is credibility, stability. This is your chance to present yourself as a government in waiting. But isn't the advantage of the Tory package that at least it's clear?
Well, I set out Labour's fiscal rules a year ago, that we would pay for day-to-day spending through tax receipts, that we would get our debt down as a share of GDP. That, of course, in difficult times, some borrowing, responsible borrowing, might be necessary. But then subject to that, we would invest in the industries and the opportunities of the future. And that's what the National Wealth Fund that I'll be setting out at conference today is all about, because there is a global race going on at the moment for the jobs and industries of the future. Britain risks falling behind in that race, whilst other governments support their businesses to get the jobs, to get the factories to their countries. But we're not doing that. My plans that I'll be setting out today would do exactly that, a serious plan for climate, for growth and for levelling up.
And over the weekend, Keir Starmer said that he would reverse this cut to the top rate, but he would keep the cut to the basic rate of income tax, along with all the spending that you would do on public services. How would you afford all of that without adding to borrowing?
Well, I've been very clear, Lizzie, as I say, that we would fund day-to-day spending through tax receipts. And that means difficult decisions, but that is the honest way and the responsible way to manage our public finances and will give us the room to invest in those industries and jobs of the future through our National Wealth Fund.
Now, the backdrop to this conference, of course, is the strike at the Port of Liverpool. Workers aren't happy because they aren't getting pay rises in line with inflation. Your deputy leader, Angela Rayner, has said that she would repeal all the government's anti-worker legislation. Would you agree with that, or do you admit that your party hasn't made its mind up on how it handles strikes and unions?
Well, I totally understand why working people are taking industrial action to protect their pay and to protect their jobs. That's why we need to get a grip of inflation. Now, the best thing that Labour politicians can do to get a fair deal for workers is to get a Labour government, and that's why I'll be setting out our plans to do exactly that in our conference today. But look, the government are having a bonfire of workers' rights. They are undermining workers' rights, and I'm not surprised that there is this industrial action. We didn't have this sort of industrial action last time we had a Labour government, because the last Labour government respected working people, respected the trade unions that represented them. That's a very different approach from what we see under this Tory government today.
But the flip side of all of this strike action is, of course, disruption. The whole point of strikes, arguably, this is the worst time to be having it. We need to have economic growth. The supply chain disruption could add to inflation. Shouldn't you get tougher on the unions? Would you get tougher on the unions like Liz Truss?
Well, what is Liz Truss doing? She is fueling the flames of this dispute and adding to the problems. We want workers at work. Workers want to be at work earning a wage. But the government's lack of respect for working people is driving them to this industrial action. We didn't have this sort of industrial unrest when Labour was last in government because we showed respect towards working people. We need to get a grip of inflation. The government's package on Friday did the exact opposite, pushing up inflation rather than trying to get it under control. Workers want a pay rise because they're seeing their wages failing to keep up with the rising cost of living. That is why we must deal with inflation to help protect the living standards of ordinary working people around our country.
So you say that they want a pay rise in line with inflation. Would you give that to public sector workers?
Well, look, we need to grow the economy, but also we've got to get a grip of inflation. The reason why there are pay demands at such high levels is because inflation is at a 40-year high. So the most important thing is that we have a serious plan to grow the economy and a serious plan to get a grip of inflation. We don't have either of those from the government, and that is why people are so unhappy with the direction we're going in.
Rachel Reeves, Shadow Chancellor of the Exchequer, thank you so much for joining me. Later on in the day, Rachel Reeves is going to present her plan for how she's going to grow the economy through investing in green measures. We'll be listening out for that later, Francine, noon London time.
Yeah, Lizzie, thanks so much. Great interview there, of course, trying to figure out exactly how Labour will position itself and the battle lines going ahead. Now, let's look at that. I'm transfixed, actually, about what's happening not only with gilts, but the pound. Traders ramping up bets of the pace and size of interest rate hikes by the Bank of England after the pound crashed due to fears over the new UK government's fiscal policies. To break down the latest market action, let's bring in Bloomberg's Danny Berger. Danny, transfixed, I say. Everyone just can't really believe what's happening.
I know, and here's the crazy thing, Francine, is the pound is down less than 1% now. These are quite the whiplash moves. We had that flash crash earlier over Asia hours, which makes sense. Liquidity is really thin. Cash markets for bonds weren't open yet. So that release valve for anxiety around the UK after Kwasi Kwarteng talked about more tax cuts, the twin deficits. That's how it played out. But this remarkable rally, yes, we're still down, but again, we have climbed back a significant amount amount of these losses. And a lot of that is because the carnage, instead of the FX market, is now playing out through the bond market. This is VAR shock type levels when you get yields across the board surging in the UK by more than 40 basis points for most of the front end here, nearly 50 basis points for the 2-year yield at a 2010 high. Part of the reason that sterling is doing better, that perhaps there's expectations that the Bank of England is going to get really aggressive. You get yields high enough, and that can entice foreign buyers back in. So what would be levels which you can entice foreign buyers? 150 basis points currently is what's priced in for November, but perhaps that's not enough. Perhaps you need intermediate hikes. This is something George Servelis over at Deutsche Bank has been advocating for, saying it's not just that, but it's also QT. You got to put it back into the market. Essentially, you need to put stability and credibility back in. Though I was talking to Martin Malone earlier, Francine, who said, nope, it should be BOE and fiscal government aligned, going full in on this trajectory and this hope for growth.
I have to say, Danny, I'm kind of obsessed with the yield curve. I mean, I know a lot of people are always obsessed, but if you look at it, I mean, it's the first time in 8 years that the UK 10-year yield is above the US 10-year yield. Let's just think about this for a second. And it was really a huge repricing for the yield, I mean, for the curve across the board, really. It was almost undiscriminatory.
It's true, but I think that's an excellent point, Francine, the spread between the UK and the US, because you have to ask the question, what sort of yield premium, what sort of risk premium are traders going to demand in order to jump in and buy this gilt market? Surely it has to be more than the U.S. We're seeing that's what it's being priced in at, but it's to some degree, Francine, is just rearranging deck chairs. Annual debt for the U.K. has now ballooned to over 200 billion pounds because interest rates are going up. It's getting more expensive to service the debt. Is there that full faith in credit? There might not be a risk premium high enough to actually entice investors back in.
Danny, thank you so much. Or Danny Berger there was with the crazy, or at least interesting, if I were so British that I couldn't, say something too dramatic, the interesting British moves. Now, Giorgia Meloni has won a clear majority in Sunday's Italian election. Joining us now to talk about all of this is Emanuele Canegrati, member of Liechtenstein Academy Foundation. Emanuele, thank you for joining us. I mean, there's so much going on elsewhere that we kind of forget that we have a new government in place, and actually not many people know what Giorgia Meloni stands for. She says one thing to the international press, another in her rallies here in Rome. What will she do fiscally?
Well, Giorgia Meloni was quite clear on the fiscal point of view. Brothers of Italy fiscal policy is quite right-oriented, so the aim of Brothers of Italy is to cut down taxes. And
can they afford to cut down taxes? I mean, look at the UK, they cut taxes.
Well, it is an interesting question because everybody knows that Italy has quite a tight fiscal space, fiscal capacity, and so this is the challenge for Giorgia Meloni, because if she wants to cut down taxes, she also to be very careful to cut down spending, and this is of course the challenge, because in Italy it's not very easy to cut benefits.
So do you think she'll be calibrated in trying to, if she cuts somewhere, she takes elsewhere?
Yes, in order to pay attention to the balance sheet. Of course, it's not easy in the financial situation, the Italian financial situation, to cut taxes, because debt to GDP ratio is absolutely high, and so Italy is observed from the European Commission, and so I think that Giorgia Meloni will be, very under the lens of.
That will depend on who she chooses as finance minister. Are we expecting a market-friendly, international, or a type of finance minister?
That's another challenge, because if Giorgia Meloni wants to, not to broke with Mario Draghi's legacy, so I presume she could select a market-friendly minister.
Is that what she'll do? To reassure Europe that
yes,
she will stay the course?
Well, my opinion is that she's rational in the end, and I don't know what Giorgia Meloni is going to do, of course, but I presume that she really wants to to say that she doesn't want to break the European Union down. I mean, she wants to stay in line in a certain sense with Mario Draghi's government.
So, Emanuele, if you're looking at this from an eagle's lens and look at the Italian economy and what the prescriptions needed are to fix it and to get back on track, what would you be putting in place?
Oh, well, it's difficult to say. I mean, what happened yesterday was quite a very strong result, not only for Italy, but for the entire European Union. And, during the electoral campaign,
I mean, she's considered far right. I mean, I don't know, at least she has a clear mandate, but I don't know if Europeans are now looking and saying, finally we have someone who's, has in the past been quite belligerent towards Europe.
Yeah, well, I mean, both the European Union and the financial markets, I believe, have a great memory. And so the great challenge is also to reconsider the semantic, if you pass me the word, the semantic of his political position. Yeah. I mean, and just in order to say, I'm far right or right. And this is the great challenge, in my opinion, because being the far right for financial markets and the European Union means something. Being right and more conservative means something else.
So as the British say, the proof is in the pudding. When do we know that pudding? Is it in the next couple of months where she'll stick or not to the EU plan? Or what are the 2-3 policies that we need to watch out for?
Yeah, absolutely. I believe that Giorgia Meloni is going to take the first choice over the next days. And it will be very important choices for both for European Union, financial markets, and well, we have a budget law over the next days, and this will be the first challenge. Yes.
But of course, it could take 1 or 2 weeks, right, for her to try and form a government. So we'll see how that goes. Emanuele, thank you so much. Emanuele Candigrati, they're member of the Liechtenstein Academy Foundation. Now, some breaking news from the OECD. It's cutting almost all of their growth forecast for the G20 next year. Not great news. I know already it's raining and we have the pound imploding, but they were actually saying that all of them are being cut down. Indonesia, the only member with a slightly better outlook, but all of them actually quite significantly lower. Now let's get straight to the Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Unilever says CEO Alan Jope has informed the board of his intention to retire at the end of 2023. Jope leaves after 5 years in the role and more than 35 years at the consumer goods giant, which has said it's facing unprecedented levels of inflation recently. Now Shell is to exit its 2 offshore wind projects in Ireland, leaving Simply Blue Group in search of a new partner. Offshore wind developer Simply Blue says it remains committed to completing the sites off the coast of Cork and Clare. The projects aim to deliver a combined 2.65 gigawatts of floating wind power for Ireland. Now, China's construction bankers setting up a $4 billion fund to buy properties from developers as policymakers step up efforts to contain a real estate crisis. The bank says the fund will invest in existing assets of property developers and renovate them into rental housing. CCB says the fund will last for 10 years with a possible extension. And that's your Bloomberg Business Flash. Francine.
Thank you so much, Leanne. Coming up, sterling crash. The pound plunges to a record low as Chancellor Kwasi Kwarteng vows to press on with tax cuts. Also, gilts on the move. Or Danny Berger flagging the UK 2-year yield now up 51 basis points. A lot of people and a lot of trading floors will probably have to be sedated now. We'll go through what happens for the UK next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Rome. Now, the pound also hovering near a record low after a frantic 20-minute sell-off this morning. by traders. Let's also look at yields, and I have to say they're off the cliff. The UK 10-year yield above 4% for the first time since 2010. Joining us now is Bloomberg's Phil Aldrich and David Finnerty. Thank you both for joining us. I have 1,000,001 questions. Let's start with David. David, what happens to sterling now? Does it go below $1? And what does it mean for government policy?
I think the key thing for sterling, certainly in the near term, is these expectations for the Bank of England to raise rates. You look at the markets already factoring in, they're raising rates by up to 160 basis points at the next meeting alone, which is in November. Now, of course, they may act before, they may not. So I think if they don't, the key thing is the rhetoric they come out, because the market's expecting this. If you don't deliver, the market will be very disappointed very quickly, and you'll see sterling sell off. So the Bank of England, any rhetoric has to be very hawkish. We have Hugh Pill, the main economist, speaking tomorrow, and markets will be looking for him to signal that they're going to do something. If that doesn't happen, I think this market expectations are unwound quite quickly, and sterling comes under pressure very quickly.
So, Phil, I know you look at this, almost minute by minute. How problematic, first of all, is it for the Bank of England to almost go against government policy? I mean, there's zero coordination here. Do the two sides regroup and rethink the way forward?
Well, actually, we had Jared Leinz. Sorry, we had Jared Leinz.
Sorry, David, let me just go to Phil. Phil Aldrich first.
We had Jared Leinz, who's one of the sort of external advisors to the government, on Bloomberg Radio this morning, and he was pointing out that this is a new economic framework. So I don't think there is going to be this kind of policy coordination of, we're going to go easy on fiscal measures to stop any inflationary pressure so that the bank doesn't need to raise rates. It's not. It's very much the plan is to provide fiscal support for households, etc., and then get inflation under control with the Bank of England. So it feels like the markets are resetting to a new political reality in the UK, and that was really drawn into focus at the budget, which was not unexpected. The measures were not unexpected, but as soon as it becomes real, it becomes tangible.
So, Phil Aldrich, what happens now? Does the Bank of England go aggressively, and what does that do to the economy, or does the government temper down what they've been saying?
I think, well, first of all, I think to try and stabilise markets, Kwasi Kwarteng, the Chancellor, is probably going to have to provide some more information on the fiscal rules that he's talked about. So there's got to be this sense that the government is going to have some kind of fiscal credibility. There is going to be some, public finance framework in place, which we haven't actually got yet. He just sort of talked about it loosely. And what the bank is clearly going to do is they're going to be raising rates, quite aggressively. We had the half-point rate hike last week. It would be quite shocking if it would send a signal of panic if they had to intervene in markets in between meetings, so before November. But by November, I mean, we're looking at a 100 basis point increase potentially in November, because they're going to have to move faster than expected.
David Finnerty, do you think that the government has just gotten market reaction wrong?
Well, certainly, it depends what the market was looking for. Certainly, I don't think it quite judged the market reaction at all. I mean, the market going into the mini budget, everyone was expecting, some giveaway, shall we say, but the size of it really did surprise the markets. I think, to be honest, it surprised the Bank of England, you could argue, because if they know this, the question would have been, would they have raised rates by 75 basis points last week rather than 50 basis points? So there's a big discrepancy going on here, and particularly with them adding fuel to the fire by saying, hey, more rate cuts may be coming over the weekend. The market obviously doesn't like this, and the sell-off is reacting to that. And now the catch is for the Bank of England, it's hands forced, because it's been expected to raise rates by so much now. If it doesn't deliver, then again, the sterling gets sold. So Bank of England in a bit of an awkward scenario at the moment.
Yeah, awkward. That's so British. It's so understated. Thank you both for joining us, Phil Aldrich and David Finnerty. Now, we'll have, of course, plenty more from the UK shortly. Let's also now bring in Lizzie Burden, who joins us from the Labour Party conference in Liverpool. So, Lizzie, you also spoke to the Shadow Chancellor. What did we learn?
Well, she was making a clear pitch to our audience, the financial markets, that her Labour Party would be more credible in terms of handling the UK economy. She's calling for credibility, which echoes the call from economists like Simon French. Remember the Panmure Gordon. Remember the fiscal event on Friday was not accompanied by a forecast from the official fiscal watchdog, the Office for Budget Responsibility, even though the OBR said that it had time to make a quick assessment of the economic impact. Kwarteng said that that's coming later in the year. And so apart from the fact that these tax cuts, and we know now that more are coming down the pipeline because Kwarteng said so over the weekend, what's offensive to markets is the amount of borrowing and this credibility point. So Rachel Reeves really trying to hammer that home just now.
Lizzie, thanks so much. Lizzie Burden there with the very latest, of course, from Liverpool. Coming up, we'll have more on the UK, on pound plunging, including what sectors, of course, we should be closely watching after the fallout. Also, watch out for gilts. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Rome. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. The pound has plunged to a record low against the dollar after the UK Chancellor doubled down on tax cut plans. The decline follows the release on Friday of Kwasi Kwarteng's growth plan, which detailed the biggest tax giveaway in half a century. Asked about tax cuts over the weekend, he told the BBC there's more to come. Now, Giorgia Meloni has won a clear majority in Italy's election, setting herself up to become the country's first female prime minister. According to projections, her right-wing alliance, which includes Matteo Salvini's League and Silvio Berlusconi's Forza Italia, took about 43% of the vote. That would give the bloc at least 114 seats and a majority in the Italian Senate. A number of small protests have broken out in Russia against President Putin's conscription plans. This as fears grow that the Kremlin may ban some men from leaving the country. Over the weekend, people waited for hours in long lines at land crossings, including Finland, Kazakhstan and Georgia. Moscow attempted to reassure citizens, saying some will be exempt from being forced to join the army. A new poll over in the US says Democrats want the party to replace President Biden as its 2024 nominee. According to the Washington Post ABC News poll, just 35% of Democrats and Democrat-leaning independents want the president to be nominated. Meanwhile, 47% of Republicans and Republican-leaning independents want former President Donald Trump to be the party's nominee. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now, let's have a look at pound, because I'm getting a couple, not many, but a couple of Twitter messages saying, why are you still implying that pound is imploding? It's off the lows. Yes, sure it is. But let's look at what happened overnight. Now, this was a very violent move. And I would suggest, as the Bloomberg copy says, so great is the turmoil in UK markets that there's now calls mounting for an emergency hike. And let's just remember, pound also tumbling to as low as 103.50, an all-time low. Now, we have seen the pound plunge on the new UK Chancellor's words. That's in the last couple of hours. We've seen gilts surge on the latest comments. So let's take a look at how the sectors have been performing. To help us analyze all of this is JP Barnett from our stocks team. So, JP, what are you looking at?
Well, I mean, we see the typical reaction to a move in a country's currency today and also on Friday. So if we look at the UK market, we see that the bigger index, the FTSE 100, is doing okay-ish. It's it's pretty much flat right now. It was a little bit in the green earlier today, but we see the wider FTSE 250, which has the mid and small caps in there, doing poorly, down 1%. So this is because we have much more export-oriented stocks in the bigger index. So we see in there industrials, consumer staples, consumer discretionary doing pretty well because they will be able to sell the products cheaper into Europe and on the globe with the pound plunging. While on the other hand, the small caps, you see pretty much the opposite. You see healthcare, you see real estate, of course, going down. You see utilities going down. Both sectors very sensitive to the rate level, and with the yields surging in UK gilts, that's not good for those sectors.
Yeah, so JP, are you also looking, of course, there's, as you say, a huge difference between the FTSE 250 and the FTSE 100. If the BOE hikes, what does that mean for sectors if they hike aggressively, even more than they have so far?
Yeah, of course. I mean, it basically will extend the story that we are seeing right now, that you see like those very rate-sensitive sectors, like especially real estate and utilities, being under pressure. It might be good for financials because the rate level is probably increasing the net interest income, but financials are also very sensitive to FX movements, so it's probably not the greatest thing for them to have. Also, like we have a nice story out there this morning, like in general, that we see like corporations across Europe facing the highest cost for refinancing their debt. So if they hike aggressively, that won't be nice for UK companies.
JP, thanks so much. As always, JP Barnett there with the latest on UK markets. Now, Bloomberg Surveillance early edition continues in the next hour. Matt Miller and Kailey Leinz are in New York. Anna Edwards is here in London. Of course, a lot of the focus will be on UK bonds plummeting after traders ramp up bets on the scale of interest rate hikes by the Bank of England. This is Bloomberg.
There's a lot of market turmoil.
The uncertainty is something that just continues to weigh on markets.
We're very much in flux now.
At the end of the day, it comes back to the dollar.
I think the UK is behaving a bit like an emerging market turning itself into a submerging market.
This is Bloomberg Surveillance, early edition with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. The pound sinks to an all-time low. Markets react after the British government vows to press on with more tax cuts. An historic election in Italy. Giorgia Meloni is set to become the country's first female prime minister and will lead the most right-wing government in the country since World War II. And the high price of war. The OECD slashes its global growth projections for next year due to the fighting in Ukraine and the impact of high energy prices. We'll be speaking to the OECD's acting chief economist this hour. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And it is here in the UK, Kailey, that a lot of the market attention is focused. And through the Asia session, we certainly saw a lot of focus on the pound.
Yeah, you've seen a lot of focus on any UK asset for both today and, of course, Friday, which was really quite dramatic. And I would note that it was quite dramatic in Asia overnight, not quite as dramatic as what you are seeing where you are, Anna. But nonetheless, when you look at GMM, that function on the Bloomberg terminal, there is literally all red, not even a single green rectangle, or you're starting to see some when it comes to equity futures on the far right side of this if you are looking at on your terminal. But for our listeners on radio, largely it has been a down day for Asian assets. You were down in Hong Kong, China, big losses in Japan and South Korea and Taiwan. You had losses of more than 3%. And you had a lot of down pressure on bonds as well. Of course, that is something that really originates in the UK, but you saw bond yields moving higher across the Asia Pacific. Commodities down on the day, palm oil, iron ore, all under pressure. And of course, it all comes back to that foreign exchange story. Every single Asian currency weaker against the US dollar today. That includes the Japanese yen, the Chinese yuan, despite China trying to make it more costly to bet against the yuan in the derivatives market. And the South Korean won, the big underperformer in today's session, it is actually at its lowest level, weakest level since 2009 on that stronger dollar, Matt.
All right, Kailey, we are seeing big red arrows here as well. Actually, not big red arrows, but we did see such big red arrows on Friday in the cash trade that futures looking set to fall even further is very bearish for this market. Right now, futures are off only 0.1%, but we fell to 36.93 in the cash trade on Friday. And I want to point out that the median estimate for a year-end finish at on the S&P this year is 4,300. So we need to rise basically another 15 to 20% to get to that level. And we don't have much time left in 2022. It's likely that you'll see those estimates coming down. The Bloomberg Dollar Index is one of the main reasons here. Another all-time high. And the chart really just goes parabolic at the end of last week. So 1344 is the level we're looking at. And for so long, we were flirting with highs of 1313. You can see we just jumped 30 basis points from there. Right now, the U.S. 10-year yield also soared on Friday, coming up even further today, another 8 basis points. So 376, almost 377. It's huge. And the 2-year-old, of course, way over 4%. And NYMEX crude coming down below $80 for, I think, the first time since January, basically. So these asset moves have been really volatile, and a lot of it has to do with the mini budget that Kwasi Kwarteng came out with on Friday.
Yes, they're described as a mini budget. Didn't feel so mini in its delivery. More a maxi budget, as our colleague has been pointing out. This is the mixed picture then, Matt, we have across European equity markets right now. The FTSE 100 underperforming. The performance on smaller cap stocks, which have less global dollar earning potential, of course, that looks worse today because some of the large names in London flattered by the weakness in the pound. The FTSE mid gaining over in Italy, suggesting perhaps the market more concerned about what's going on in the UK, and we'll see this in the FX markets as well, than by what's going on in Italy politically. Let's have a look at that Italian story then. This is the FTSE MIB up by 1.2% this morning. We see some of the infrastructure plays in Italy. A bit of a sense of relief that things maybe are panned out as the markets had anticipated them at least to be. And we have also heard from Giorgia Meloni talking about governing with responsibility. The UK government, though, has continued to talk about tax cuts and focusing on growth at a time of inflation and high debt. And that has continued to concern the markets. We dipped down to 103 on the pound against the US dollar, and all of the talk is about whether we get to parity on cable. That was during the Asia session. We've clawed back some of that as European traders have got back to their desks. So we're now back up at 107, but still an options positioning, I should say, is a little more muted than parity. But certainly that is one of the areas of conversation. And here we have the pound selling off against the euro as well. So the euro continuing to gain despite that victory for a far-right alliance over in the Italian politics. Despite that, the market's very much more focused on what's going on in the UK. And this is a clear example of that, up by 53 basis points on 2-year yields here in the UK this morning, Matt.
Yeah, let's get to those moves that we've seen in the UK. Really our top story today, the pound, as Anna mentioned again, falling at 1 point to 103, an all-time low against the US dollar. Gilts crashing after the UK government vowed to press on with even more tax cuts. We've got team coverage for you. Bloomberg's Lizzie Burden is at the Labour Party conference in Liverpool, and Bloomberg's Danny Berger is covering the market reaction from our studios in London. Let's start with Lizzie Burden in Liverpool. Lizzie, is there a chance of an emergency hike from the Bank of England as we see the pound plunge?
Well, traders are pricing for that. They're pricing for 150 basis points of hikes by November, implying that we're going to get an intra-meeting hike, even before the pound's fall today, which of course is caused by the Chancellor Kwasi Kwarteng saying that he's going to add to the fiscal package from Friday with even more tax cuts funded by borrowing. Even before all this, on Friday, an analyst at Deutsche Bank was saying that the Bank of England does need to step in if it's to regain credibility. There are also questions about whether the Bank of England is going to reverse its or pause its active gilt sales to avoid overwhelming the market. But really, the question for Andrew Bailey is, after all the criticism of monetary tightening financing, is he going to want to react to fiscal policy in this way and be accused of taking his eye off inflation? Really, he may not want to add to the panic, but that panic is already there.
OK, certainly seeing that in some asset classes today, Lizzie. And you're in Liverpool, of course, because the opposition Labour Party is meeting there, trying to formulate their line of attack to oppose the Conservatives' fiscal announcement. How are they trying to present themselves?
Well, we've just spoken to the Shadow Chancellor, Rachel Reeves, appealing to the financial markets, saying that they would present a more credible offer to the financial markets. Keir Starmer, the opposition Labour leader, over the weekend has said that he would not go ahead with the cut to the top rate of income tax. Remember, that was the rabbit out of the hat on Friday from the Chancellor Kwasi Kwarteng. But he would continue, Keir Starmer, with the cut to the basic rate of income tax, as well as spending on public services. So the big question at this conference is, how are you going to pay for all that? They also need to set out a clear, broad vision for how they would govern. And of course, there are divisions in the Labour Party right at the top. We're here in Liverpool, where strikes are happening at the port, and at the top of the party, divisions over how they would handle strikes and unions. So it's an open goal for Keir Starmer, but he's got to sort out the issues in his party first.
All right, Bloomberg's Lizzie Burden reporting from Liverpool. Thank you so much. And Lizzie will be joining us again later this hour with Pat McFadden, Shadow Chief Secretary to the Treasury. Now let's get more on the market reaction to what's going on in the UK. Bloomberg's Danny Berger has more on the fallout. And Danny, I keep looking at these charts of UK assets, wondering if these are really intraday charts. The moves are remarkable.
It is extreme whiplash, especially looking at something like sterling at one point cratering to an all-time low, falling more than 4.5% in the Asia market session. But now at the moment, the pound versus the dollar is weaker by only 0.7%. It's not even down one whole percentage point, even more. And a lot of this is because during the Asian session, it was really only sterling that served as the release valve of this concern on the state of the UK economy. But with the cash market and bonds up and trading, that is where we're seeing the pain. This is a crisis of the bond market, really centered around this idea that at the moment, debt servicing costs have tripled to an all-time record. There's concern there with how the government is going to fund itself. I mean, 55 basis points worth of gains in the two-year yield. This is financial crisis level moves. We haven't seen gains of this since 2009. It's VAR shock. That's the kind of feeling we're getting from this bond market. Now, part of it is an aggressive pricing from the BOE. Lizzie was just going over this idea that they need to entice foreign buyers in. About a third of foreign buyers own the gilt market, so you need to do something dramatic to get them back in. But at the same time, is it just rearranging deck chairs because we have this issue of the government funding itself? I was talking to Martin Meloni of Alpha Book, who basically said the government and the BOE actually need to work in tandem. They need to be pro-growth together. Otherwise, they're just kind of opposing themselves, and it's going to be difficult, again, to get foreign buyers interested in and help back this new fiscal policy.
All right, the value at risk call is, I think, really interesting. The question is, are we going to start seeing hedge funds blow up, as a lot of them could have been on the wrong side of these trades? Danny, thanks very much, and thanks to Lizzie as well. We'll talk with her later. Now, Italy is on track to name its first ever female prime minister. Giorgia Meloni won a clear majority in Sunday's election. That sets her up to head the most right-wing government since World War II. Meloni spoke yesterday.
It seems clear to me that what came out from the first projections is that Italians in these general elections have expressed a clear indication that they want a center-right government led by Brothers of Italy.
Bloomberg's Francine Lacqua joins us now from Rome. So, Francine, take us through the results and tell us as well, what does it mean, the most right-wing government? How do we gauge that?
Yeah, so we gauge by policies, and good morning to you, Matt. We gauge by policies. We gauge, of course, her stance on LGBTQ community rights. We gauge it on immigration. Some of the things that she said is certainly Italy first, and this is, I think, the concern for the market. So first of all, we have the first female prime minister. She hasn't been given, of course, a chance to form a government yet, but given her large win yesterday, it looks very likely. She is also, in her policies, a bit of an enigma. Wrapped in a mystery, because markets have been hearing what they've been told by her and her insiders, which is basically that she wants to stick to the fiscal rules. She doesn't want to rock the boat. She will comply with the EU, but she also has to find money to try and, alleviate the cost of living crisis, which is huge here in Italy. At the same time, because of some rhetorics coming from this far right, including her saying that actually she certainly didn't disagree in certain policy with Viktor Orban of Hungary, there's a question mark on whether she's ready then to fight with the EU. I have to say the market for the moment pretty placid. It looks like they believe her to her words that she will go forward, stick to the reforms initiated by Draghi, and get that 1.9 billion euros of money by the EU in December.
Yeah, Francine, she seems to be talking about behaving responsibly, about fiscal responsibility. The action, the focus for markets is in the UK, of course, today when it comes to these two European political stories. So how instructive is what's happening in Britain to Italy with its large debt pile and with markets watching their focus on responsibility?
Well, because Anna, and good morning to you, of course, the polls were largely right in Italy. I have to say we've been texting with a lot of the sources in government, outside government, people here on set, and they've been saying, wow, look at the UK. Maybe this is a warning shot for Giorgia Meloni and her government. Remember, Giorgia Meloni would not govern her alone. It's with her centre-right alliance, which includes Silvio Berlusconi and Lega, but they haven't done as well as expected. And so some of the promises that they made in terms of course, tax cuts, in terms of spending more, may have to be revisited in the light of what's happening to pound. Now, these are two very different economies. And if you look at Italy, they don't really have any fiscal maneuvering. Their debt pile is huge. And again, they've done these agreements with the EU. So I've had more and more people coming on set saying, wow, look at the pound. First question is, can you still afford an espresso if you're coming from London? The second one is, of course, maybe Giorgia Meloni is looking at what's happening in the UK and giving her a steer on how much she can push fiscal spending.
All right, Bloomberg's Francine Lacqua reporting from Rome. I hope you can get an espresso before you join us again later this hour for an interview with Fabia Foy, head of research at Anima. But before we get there, let's get back to the U.S. markets now and take a look at some stocks moving in pre-market trading. Two of the big movers to the upside are U.S. listed Macau casino stocks that have companies that have big operations in Macau, after it said that tour groups from mainland China could resume as early as November. So that would give a big lift to players like Las Vegas Sands, which gets about 60% of its revenue from its Macau operations. It is up about 7.7%, while Wynn Resorts, also a big player in the gambling enclave, is higher by nearly 7%. Another group of stocks not doing as well this morning, though, include anything tied to commodities. You are seeing a little softness in the commodity complex, in part due to the stronger dollar, in part due to just growing concerns around demand as there is a deteriorating growth outlook. That means the energy select sector SPDR ETF, which is essentially a gauge of how the sector overall will do come the opening bell in just about 4 hours and 15 minutes time, is down about 0.5% before the bell. Anna.
Okay, Kailey, lots to talk about then with Mark Haefele, CIO at UBS Global Wealth Management. What is his appetite for UK assets this time? What does he make of the big moves we're seeing higher in UK yields? And later this hour, paying the price of war. The OECD slashes its global growth projections for next year. We will speak with the organisation's acting chief economist. That conversation coming up shortly. This is Bloomberg.
I think the UK is behaving a bit like an emerging market turning itself into a submerging market. It would not surprise me if the pound eventually gets below $1 if the current policy path is maintained.
Larry Summers there, former U.S. Treasury Secretary, speaking with Bloomberg's David Weston on Wall Street Week. Mark Haefele, CIO at UBS Global Wealth Management, joins us now. And Mark, I'd love to know what you think of Summers' characterization of the UK economy. He says, you know, since we've had Brexit, we've had fiscal policy and monetary policy mistakes that seem to make the UK look like an emerging market. Do you agree?
Well, if we're going to start with, you know, an economist in economic theory, let's start at the top and say what's going on in the UK probably proves that this modern monetary theory is hogwash and it doesn't work. Certainly, you know, post-Brexit, I think you were doing a comparison with Italy. You know, Italy's still part of euro and the European Union, but nobody really needs to invest in the UK. As a global investor, we don't need to invest in the UK. And you're seeing that play out in these markets. And the other thing we're seeing play out, as now we've gone away from negative rates and the tide has come out a little bit, we're seeing the way that this really starts to play out in currencies in particular, and that's going to be a real feature of the world ahead of us. So that's the macro. But then I'd say on the micro, when we aggregate up our stock exposure towards things like value, towards things like energy, we actually have a lot of stocks in the UK because, as you've said, the FTSE, the larger cap stocks, are getting much of their revenues from outside of the UK. And so that might be a place for UK investors to look to hide from some of this turmoil.
I wonder if, the UK has a lot of prestige. We care about the UK story more than we care about bigger economies like Germany because I guess they speak the same language as we do. They used to be a huge naval power, and so many bankers love living in London. Did they lose that? Has that all come out of the price now with the pound at 107?
Well, I'm not going to bet against London, which, as you said, many people around the world have an enormous affinity for. But, just look at what has happened to the price of real estate in, say, Frankfurt or in Amsterdam, and you get to a little bit of an answer to your question in the relative rebalance for bankers and financial centers, the financial center of Europe, as we go forward.
Mark, good to speak to you today. Do you think the Bank of England needs to come forward with some kind of emergency rate hike? And what would the right size, if they're thinking about it, what would the right size of such a move be? Too small and it risks underwhelming? Too large? Does it look like panic and do damage to the economy? What would go through your mind?
Well, first, that they're in an extremely difficult spot. I'm not sure. Look, there's no one right answer because, as you've pointed out, and as many people have pointed out, this is an interplay of various forces that should probably in some ways align first and then act later, and that hasn't been happening. So as I said, we can't predict exactly how they're going to try to navigate this. So we want to look for the areas, those companies that are getting their earnings from outside the UK, and bet on the sides of this where we're a little more sure of what the outcomes are going to be.
And more broadly, some of the things you're looking at in terms of market strategy at this point, Mark, you're talking about positioning for security. And that's not just defense, that's security around all things, around environment, around food security, technological security. Where are the opportunities there?
Well, look, that's absolutely true. And I think over the longer term, looking towards sustainable sources of energy, that's, if you look at China, that's clear government policy supporting that area of the market. If you look at what's going on in the U.S., there's more government support for that. Same thing in Europe. And so over the longer term, that kind of security is going to be a key role for investors who are looking to bottom fish a little bit. For us now, security absolutely involves energy, and it's going to be a very interesting year for Europe as these gas supplies start to run low in, say, February and March. I think that Mr. Putin is looking to test that unity in Europe, and that's going to be a critical juncture as we go forward over the next 6 months.
How much security or safety are you looking for in cash, Mark?
Well, I think that we've got a new world now where you can actually get something of a return on bonds. And so we are overweight high-grade bonds here in the sense that we think it can provide some cushion and ballast in a portfolio in these turbulent times. We're overweight the dollar and the Swiss franc as safe haven currencies. I think Switzerland has the capacity to and the will to meet inflation. And the U.S., is in this scenario where, because there is inflation, but there still is a lot of growth, the Federal Reserve can and will speak very hawkishly going forward and continue to act. And then the dollar in here, of course, has that geopolitical hedge in the sense that the U.S. remains independent of the energy woes that are going on in Europe.
Yeah, and we just continue to see the dollar going from strength to strength at the same time that we're seeing rates climb higher and higher. Many of us thought the high of the year may already have been in on Treasuries. Clearly, it was not. We're at 377 almost this morning. Is your year-end forecast still 3.5? And what gets us back down there when the trajectory all around the world seems to be yields up?
Well, you're right. I mean, I think that we see some breaks on how high this can go. Obviously, there's many factors in flux, but if inflation starts to roll over and some of these Fed rate hikes start to take effect, which we will, we've seen areas of weakness starting in the United States, say around housing, and as that has an impact, that should slow even further expectations for future inflation and also expectations for how much growth is going to be on the other side of these Fed hikes. And so both of those can act as a brake on how high the 10-year goes.
We saw the market, the S&P drop to less than 3,700 mark on Friday. That means we have to climb more than 16% to get to the median estimate that strategists have for the S&P at year end. Do you think we're going to start seeing those estimates come down, or is it likely that stocks can rally back up that high by the end of 2022?
Well, I'm very pleased that we've for some time taken the under on that. We're at 3,900 at the end of the year, which admittedly today seems optimistic. Look, I think that this goes, whether it's CPI print or other data point by data point, around what the Fed is going to do. This Federal Reserve is not driven in a formalistic, mechanic way on their next moves, and so that creates a lot of speculation and flexibility what their reaction function is to every data point. Now we've seen that as this inflation has persisted, we think the risk of inflation and a soft landing has come down a bit, and that's reflected in our end of the year pricing.
All right, well, we have just about 3 months to go. Mark Hayfele, CIO of UBS Global Wealth Management, thank you so much for joining us. And later this hour, we will talk about paying the price of the war in Ukraine as the OECD slashes its global growth projections. We'll speak with acting chief economist next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. The pound sinks to an all-time low. Markets react after the British government vows to press on with more tax cuts. An historic election in Italy. Giorgia Meloni is set to become the country's first female prime minister and will lead the most right-wing government in Italy since World War II. And the high price of war. The OECD slashes its global growth projections for next year due to the fighting in Ukraine and the impact of high energy prices. We will speak to the OECD's acting chief economist next. Welcome back to the program, everybody. I'm Anna Edwards in London, Matt Miller and Kailey Leinz in New York. And Matt, of course, risk assets here in Europe under pressure, quite a lot of contagion from the UK story.
Yeah, absolutely. And although you see some pockets of green there in terms of the equities trade, that is not what we see here. S&P futures continuing to fall now further. Remember, just 30 minutes ago, we were off 0.1%. Now we're down about 0.6%. And this after closing below 3,700 in the cash trade on Friday. So big concerns in terms of risk assets continuing into the start of this week. Part of the reason is the Bloomberg Dollar Index. Right now at 1344. Remember, we were pushing around 1313 for an all-time high. Now we've just gone parabolic here. And it's surprising to me that even with this huge gain in the dollar index, you don't see a bigger drop in Bitcoin. I saw it a second ago, but it's gone now. In any case, Bitcoin, $19,100. It doesn't matter as much as these other assets. These are more important, obviously, to focus on for the broader market. The 10-year yield up to 377. Unbelievable moves. It's not just UK assets that are getting whipsawed around, or rather just moving violently in one direction. US assets as well. I mean, these yields are incredible. NYMEX crude as well, below $80 a barrel for the first time since, I believe, January, maybe February, but the first time since the beginning of the year. So this shows real concern that the demand side of the equation is going to come under real pressure. Kailey, what do you see in terms of the pre-market movers?
Well, to your point on demand concern in commodities, you are seeing some commodity-sensitive stocks under pressure in pre-market trading, including in the energy complex. ConocoPhillips is down right now by about 0.4%, while Freeport-McMoRan, a material stock, is down by about 1%. There are some big gainers out there this morning, though, including U.S. casino companies listed here in the U.S., but have big operations in Macau. The likes of Las Vegas Sands, which gets about 60% of its revenue from Macau, is up about 6.8%, while Wynn Resorts is up 6%. Of course, the news there is that Macau has said tour groups from mainland China may begin resuming again come November, Anna.
And Kailey, let's have a look at the European picture then. Nervousness around risk assets down by 0.6% on the Stoxx 600. So earlier optimism around the FTSE MIB certainly being eroded a little bit. We're still positive. That is one area of green. Broadly speaking, though, we are weaker across European stocks. Nervousness about the fiscal picture in the UK. That's the main point of concern right now. 107.54 on the pound. It went down as low as 103, a new all-time low post-decimalisation for the pound. That was during the low liquidity of the Asia session. It's clawed its way back a bit, but still off by 1%. And here's another illustration of that move in UK assets. So we're down on the pound. UK yields going higher and a 50 basis point jump in the 2-year. And yes, Kailey, that is just in one day.
Absolutely remarkable moves. And we've also gotten some moves from the OECD, Anna. It has slashed its global growth forecast for next year, saying the world has been jolted by the war in Ukraine. The Paris-based organization says the global economy will expand just 2.2% in 2023. That's down from its previous forecast of 2.8%. And it also says that inflation will still have a 6 handle for the G20 economies next year. Joining us now to discuss is the OECD's acting chief economist, Alvaro Pereira. Alvaro, thank you so much for being with us. You say in the report that due to those persistent inflationary pressures, central banks need to continue hiking interest rates. At the same time, supportive fiscal policy is needed to help cushion the blow of higher energy costs. What is the proper balance of that, given we are seeing today the impact of fiscal policy plans in the UK absolutely roiling assets across the board?
Well, good morning. Our forecast certainly is a challenging one because we are forecasting a significant slowdown of the economy to, say, the United States growing at 0.5% next year, the euro area growing 0.3%, and still a slowdown in China this year and next year recovering a little bit, but still, globally, we're talking about significant slowdown. We believe that right now the priority has to be, for sure, bringing inflation down. It's crucial because real incomes are going down quite significantly, and delaying adjustments would only mean that we're going to have problems on the line and probably even bigger adjustments to be made. So that's why we say very clearly that first of all, monetary policy should continue to tighten in the advanced economies. Also in the emerging markets, it's crucial that it's still early to undo the tightening that took place a bit earlier. So likely they'll have to continue to tighten a little bit. And together with this, it's crucial that fiscal policy works hand in hand with monetary policy so that fiscal support is targeted and temporary, but also without leading to a substantially further stimulus into the economy, because a lot of economies have high debt levels, and it's not prudent to do so.
Well, and of course, there still remains a big energy question hanging over both monetary and fiscal policymakers. How do you model out the uncertainty around energy in economies like Europe, and what kind of downside risk it could pose to growth and upside risk it could pose to inflation?
Well, we have a scenario, in fact, that calculates this. So first of all, it's important to realize, especially for Europe, what are we talking about? So just to give you an idea, storage levels right now in Europe are about 90% in most countries. But storage levels, the capacity is only 110 billion cubic meters, whereas an average consumption during winter is about 290 billion cubic meters. So we're talking about a substantial gap. So even though many countries are trying to bring more supply to the fold, this likely will not be enough. So what we calculate is that we need to reduce demand between 10 and 15% in Europe in order to avoid gas disruptions. But we have a scenario that shows exactly that if we have gas disruptions and energy prices, especially gas prices, go up by 50%, what is the impact for the world economy? Well, we calculated that for Europe, for example, growth would be even lower, will be 1.3 percentage points lower than the already very low 0.3% growth forecast that we have in our central scenario. So basically, Europe will be in a big recession, or at least in a recession. On the other hand, we would have additional inflation of about 1.5% in Europe, and in fact, around the world, 0.5% more. So we're talking about the scenario in which, if we have big energy disruptions, we would end up with even less growth and likely a recession in many countries. At the same time, more inflation.
Okay, good to see you, Alvaro. There are clearly big global forces at work here. There's also domestic decision-making to be done. We sit here a few days after a big announcement from the UK on the fiscal side. How concerned are you about the trajectory of UK fiscal policy?
Well, first of all, because the mini budget came on Friday, and this was not still incorporated, and we don't know all the parameters. This was not incorporated in our forecast. So I should say that is important to say. Secondly, we believe that we reiterate our policy message. I think monetary policy needs to tighten now. And just to give an idea, right now we calculate that 80%, well, inflation is growing at, or prices are growing at more than 4% in 80% of all goods and services in the UK, which is higher than the euro area or higher percentage than in the United States. And on top of this, we believe that is quite important that, as I said, monetary policy works hand in hand with fiscal policy. So we reiterate the message. We believe that it's quite essential going forward, because otherwise the adjustment and inflation rising will be likely higher.
Although, Alvaro, we see, it seems to me, around the world, monetary policy working at cross purposes with fiscal policy. In Japan, in the UK, in the US, it seems that central banks are trying to make up for government moves.
Well, we believe that, again, we reiterate our message. We understand what is at stake here. We also understand, for example, in many countries, not only in Europe, but also in Asia, energy prices are going up fairly dramatically. So there is the need to support especially vulnerable households and potentially some sectors. But we think that is very important. If we want to get the job done as quickly as possible without big disruptions down the line, it's absolutely essential that monetary policy and fiscal policy work hand in hand. But, you know, give an example. Japan right now is a bit different case, because Japan inflation, even though is rising a little bit, is still very low level right now. So we understand the position of Japan. Of course, other countries like China, they don't have a lot of inflation right now. So there, the fiscal stimulus is working its way, and will work its way a little bit next year. So it really depends on specific economies. But overall, in many countries around the world, monetary and fiscal policy should work hand in hand, so that we are not able, we don't get into a situation in which things get a bit more uncomfortable for all of us.
Thank you so much, Alvaro. Good to see you. OECD's acting chief economist, Alvaro Pereira, thank you for your time. Coming up on the programme, a new government in Italy. Giorgia Meloni is set to become the country's first female prime minister, as Italy tacks once again to the right. We're live in Rome next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, an interview with the President on the United Nations General Assembly. That's at 6:30 p.m. New York time. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kailey Leinz in New York. Anna Edwards with us out of London. Giorgia Meloni has won a clear majority in Sunday's Italian election, setting herself up to become the country's first ever female prime minister. Let's get back to Bloomberg's Francine Lacqua in Rome. Francine?
Hi, Matt. So this will then depend on what Giorgia Meloni uses as coalition. For the moment, she gave one speech after her victory. It's, almost 95% sure that she becomes prime minister. And she was saying we need to stay the course. So to ask all about this coalition building and what her priorities will be for the budget, we're joined by Fabio Fois. He's head of research at Anima. Fabio, thank you for joining us. If you're in Giorgia Meloni's shoes right now, what kind of clear message would you give to markets?
Well, I think the message for markets is very simple. For the time being, in the very short term, just stay a little bit on the side. Let's see how things develop. We learned something very important from the result of the election of last night. So the center right won the election, fine, but the composition of the coalition that will lead Italy for the coming years is on the margin less sovereignist than it was before. Because if on the one hand we have Giorgia Meloni, brother of Italy, right-leaning, we have Liga, who did very poorly in the election. So on the margin, I think this coalition is slightly more pro-Euro than market had expected. However,
but Fabio, yeah,
please.
The problem is that they need to square the circle of there's a huge cost of living crisis. So they need to give money to the people that need it most, but they've also promised tax cuts.
Yeah, that is correct. That is correct. I think that they will try to deliver some of the fiscal easing they promised during the electoral campaign. In a way, they have room to find the resources needed to fund some of those measures. For instance, the entire center-right coalition is very much against the reddito di cittadinanza, so the universal income. That costs a lot of money to Italy every year, something like north 10 billion. If you cut that measure, then you have space to do something, to deliver on some of the promises you made, in a status quo level. I think it's important also to bear in mind what Giorgia Meloni had been saying during the electoral campaign. She doesn't want to have a confrontational approach with Europe. She said, for instance, differently from Matteo Salvini, she said, well, I'm not in favor of expanding the budget because I'm well aware that Italy has its own issues with debt. I think these guys, they know very well that they need the protection from the ECB to be protected, to be eligible to for the TPI program. Italy must comply with PNRR policies, milestone and target, and also must have sound public finances.
Fabio, this is, I think, an important point, right? Because a lot of people have been saying center-right. We see that in a lot of European nations with no problem. Indeed, core nations like Holland and Germany have had center-right coalitions. Others have said the most right-wing, majority since World War II, which sounds scary. It sounds like Hungary or Poland, right? They've had real problems with the EU. Which is it, and how is the EU going to deal with this government?
Well, I think that the EU will be very pragmatic as much as Italy will be very pragmatic. So long as Italy comply with the request of Europe, so in particular with the milestone and the target of the RRP, I think that the relationship will be decent. Going into the budget, there might be some tension, but at the end of the day, I think that this tension will be fixed for one very simple reason. If Giorgia Meloni looks around herself, she finds two guys, Silvio Berlusconi and Matteo Salvini, who tried in the past, to be confrontational with Europe, and actually, it didn't really work out very well for their political career.
All right, Fabio, thanks so much for joining us. Really interesting stuff. Great to get your insight. Francine Lacqua as well. Excellent coverage there from Rome. We will continue to cover the Italian election results, but we're also going to focus in on the UK. Pat McFadden, the shadow chief secretary to the Treasury, joins us after the mini budget that we saw released from the Conservatives, Kwasi Kwarteng, on Friday drove the pound down at one point to $1.03, the lowest ever. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. Let's get back to Bloomberg's Lizzie Burden, who joins us from the opposition Labour Party conference taking place in Liverpool against a backdrop of market volatility then, Lizzie. And you're joined by Pat McFadden from the Labour Party.
Indeed, I am. Thank you, Anna. Pat, thank you very much for joining me and making time for me. Pat McFadden, Shadow Chief Secretary to the Treasury. The pound's tanked this morning after the Chancellor Kwasi Kwarteng announced that he's going to do even more tax cuts on top of all the fiscal announcements on Friday. What lesson does your party draw from this experience in markets? Will it be instructive as you set out your plans for spending and borrowing?
Well, we were very concerned on Friday about the scale of the package and the fact that it was entirely to be funded through borrowing at a time when inflation was already high and there was already pressure on the Bank of England to raise rates. Both the package itself and the Chancellor's comments since then appear to have resulted in this very adverse market reaction where the pound, to use your word, is tanking. And there's another effect also playing out, which is that the cost of gilts is increasing now above 4% in markets this morning, very significantly ahead of where they were a short time ago. So not only are we increasing borrowing, but we're making the cost of servicing that borrowing more expensive. This is a risky time for the UK.
So what level of yields is needed to attract foreign investors to UK markets?
Well, I wouldn't pick a number, but what I would say is people need to have confidence and stability. And what we've got is instability. We had a Chancellor who stood up on Friday and took everything that the Tories have said for the last 12 years about debts and deficits and set fire to it in public and described it as resulting in a vicious cycle of stagnation. So you had this huge policy flip-flop, which was not accompanied by a report from the Office of Budget Responsibility to let us see what the overall macro effects of that would be. You had the sacking of the permanent secretary, and you've got this tug of war going on between the government and the Bank of England. The metaphor that's been used is the government putting its foot on the accelerator, the bank putting its foot on the brake. That doesn't lead to a stable situation.
So Kwasi Kwarteng's backing the financial sector. He wants to achieve 2.5% annual growth. He's lifting the cap on bankers' bonuses to stop the exodus to Europe. What's your offer to the city?
Well, I used to be the Labour Party's spokesperson on city matters, and I think the financial services sector is hugely important to our economy. It's a huge wealth generator, it's a huge source of tax revenue, it's a huge source of employment, and it also gives us an edge that many countries in the world don't have. So I just wish there had been a modicum of concern for the importance of that sector when the government forgot all about it when it negotiated its Brexit trade agreement, completely leaving the sector out, not making any priority of it at all, and not showing any concern for its market access in future. So I do think the sector is important, but I think the importance of the sector is about more than things like the bonus levels of the richest people working in it.
So we've got chaos in UK assets. The eyes of international investors are on your party to see what you might offer as an alternative. What do you tell international investors that you stand for?
Well, I think as the markets are reacting to what the government has done, the public will look more to the Labour Party. So this week is a really important week for us. And we want to ensure the public that they can trust the Labour Party to run the country responsibly. So when we announce policies, we like to say how they'll be paid for. We like to have a balance between the tax revenue raised and the borrowing that any government has to do to fund things in a more balanced way, and also to project institutional stability. This is hard to quantify, but it's really important for countries. I think the Conservative government has played fast and loose with our institutional stability. We're going to need more of that in the future.
Pat McFadden, Shadow Chief Secretary to the Treasury, thank you so much for joining me. Anna, back to you.
Lizzie, thanks very much. Thanks to Lizzie Burden at the Labour Party conference and to Pat McFadden there. And really stunning to look at the moves that we're still seeing in these bond markets, gilt yields on the rise. And Matt, you were mentioning what's happening with Treasuries. So sort of linked, not linked, these stories, of course. This is having ripple effects across the Atlantic and around the world. Yeah, absolutely. And the question is, does it continue? If so, do we see some big blow-ups? I mean, these moves have been absolutely massive in assets, Kailey, that are traditionally very stable, right? So if you take the other side of this bet, you may not expect to blow up.
It's just anything but stable. The 2-year gilt yield is about 100 basis points higher today on this Monday than it was at the end of the day Thursday. Anna, it is just astounding. Yeah, that is it for the early edition. More surveillance is ahead. Tom, John and Lisa will keep their eyes on the gilt markets and all of those markets on the move in response. This is Bloomberg.